I'm sure all of you would be familiar with Kaustubh and his association with Birla, but just for some of you who might not be aware, Kaustubh has been with ABSL AMC for the last since 2009 2010. He had been managing many of our duration products over time, and currently is our head of a co-head of fixed income, overseeing our duration products. And in terms of his track record, I can share that over the time, over more than a decade that I have seen the products that he has been managing on the duration side, almost 90%, in fact, more than 90% of his AUM of the funds that he is managing have been in Q1, Q2. To pick up any quarter and look at 1 year, 3 year performance, and that has been there. And if you look at top quartile performance, it would be safely well above 75%. So it's an extremely a strong track record on the duration side of the products that he had been managing so far, and continues to manage some of them even now. So today we are going to be having this conversation over the next 1 hour, and what we intend to cover are essentially three elements and three agenda items. Number one is, of course, the inclusion of Indian government bonds in JP Morgan Emerging Market Index, and what is the impact, etc. I think is something which is fairly well known, broadly discussed in media and in investment corners over the last few weeks. So, what is our take on that? This number one. Second thing that we'll discuss is the US Treasury yields, and given the levels of US Treasury yields as well as the yield curve there, I think it's at a very interesting juncture. And what kind of opportunities does it offer for Indian investors is point two that we will discuss. And third, of course, we can't conclude the conversation without really picking Kaustubh's brain on tomorrow's monetary policy. So we'll just touch upon that element as well. And then in the final 15 minutes or so, we'll kind of keep for Q&A. So if you have any question, please post it in Q&A section, and we'll be very happy to moderate those questions and seek Kaustubh's response on them. So Kaustubh, over to you on the first part. I think emerging market, within emerging market, India is the third largest bond market. And with the kind of, I think, if I'm not mistaken, we are offering the highest yield, with the kind of macro stability that we are seeing currently in India. And given that, we're very happy to see our inclusion of our Indian government bonds in JP Morgan Emerging Market Bond Fund ETF. And I think what is this measure all about, both in terms of the impact in terms of flows, as well as other qualitative impact on our bond market in general, and the yield levels. If you can just share your views on that, it would be great.
Yep. Thank you, Bhavdeep, and good afternoon, everyone. First of all, thank you, Bhavdeep, for the kind words. But we are in the business of money management, and of course, past returns are subject to market risk. But the endeavor is to maintain the performance for our investors, especially risk-adjusted performance, and to be truthful, then that team is responsible for it, and just not one person. Now, okay, let me start with the big news, I think, which is why this call is for, is that the impact of index inclusion. So look, on 21st of September, JP Morgan announced that India will be part of this JP Morgan Emerging Market Bond Indices. And the announcement has come now, but the effect of this announcement will start in April of 2024, where starting, June of 2024, where starting from then, every month of their overall AUM, they will add 1% weight to India, which means that as the number stacks up, currently the total indices that they are, or the total AUM that these funds are managing is closer to $235 billion, and 1% every month, taking it to 10% till March of 2025, makes it safely, one can assume that India will get excess of $26 billion inflow during that 10 months period. Now, our interaction with these guys, it reveals somewhat a much more better story, in the sense that our understanding is that a lot of guys, they do passively follow these indices, which means that although they replicate these indices, but they are not part of this $236 billion corpus. So in essence, this number could be as high as closer to $300 billion instead of $236 billion, which means that potentially between January of 2024 to March of 2025, we could see debt flows closer to $30 billion. Uh, why this is a big news as such, in the sense that uh, as you can see that post 2016 the FI ownership in emerging market has generally struggled beyond China. uh, they There was a continuous feedback loop which was coming from the investor to these indices, that they want India to be part of it, but for some variety of operational reasons and some basic needs, they were not part of it. But now, given that 73% of the investors, they were in favor of India being part of this, the indices manufacturers, they have given up on their demands from the Indian government, and they have decided that they will include India into it. As a matter of fact, and to some extent you can say a matter of pride, that to become part of it, India has not given any kind of tax relaxation, and there is no operational clearance, in the sense that the demand was that Indian bonds to be part of this indices, they need to be euro clear. Even that demand has not been relaxed by authorities, which means that it's a testimony there is a genuine demand to own Indian assets, and which is why, despite no relaxation, uh, these indices are now taking India into its fold. In terms of depth of this market, India, if you look within the emerging markets, India is third largest emerging markets. India is one of the most liquid emerging markets, and of course, Bharti rightly said out, it is one of the highest yielding emerging markets. So, in a sense, that what we are seeing in equity, that investors, after a relentless selling in 2022, they have come back with vengeance in first half of 2023 to own Indian equities. We can expect similar kind of vengeance buying from these investors, foreign investors, to own piece of India debt. As we speak, total ownership of India govies held by FIs is less than or closer to 2%. Even after this inclusion and taking 30 billion inflow dollar, that number will be just closer to 4.5%, which means that uh, the overall ownership pie still will remain largely with the domestic savings, but instead of 2% pie, passively 4% pie will be owned by these FI guys. Now, why? In a sense, if the number is just 4%, then does it a big number, or there is any real advantage of getting into it, or what are the costs associated with it? So let me first take you through some of the advantage. The most important advantage is of course that India is a current account deficit country, and we are dependent on capital account flows to fund our current account deficit needs. Uh, on an average, India is dependent on FDIs and FPIs to the extent of 50 to 60 billion dollar every year. Assuming that FDI flow uh, has been closer to $30 billion in net terms in last 5-10 years, this will address some bit of apprehension on financing our current account deficit flows. Um, Also, in short term, it will also help in boosting our foreign exchange reserves. As a matter of fact, our total foreign exchange reserves as a kitty is closer to $600 billion. Again, uh, it is third largest in the world, and adding this flow will give some bit of stability to the rupee movement in entirety. The second advantage is that because these flows are generally or these funds are passively managed funds, so unlike equity, or you can say unlike the past experience of debt exposure through FPIs, one can assume that these flows will be relatively sticky in the nature. So $23 billion or $236 billion of total AUM, which is passively managed, that flow will remain sticky. If some flows which comes to preempt these inflows, probably that flows can still remain volatile. But by and large, the significant chunk of this flow is likely to remain sticky. However, these are one-time flows in the sense that this, in the sense that this AUM accretion of 25 to 30 billion dollar will happen one time, and then it will be just mirroring the pace at which the emerging market bond index is growing. Now, it can grow or it can degrow. But for calendar year 2024, we are going to get one-time flow of this 25 to 30 billion dollar. The third advantage that this acceptability does is that it exposes these foreign investors to Indian fixed income market, which means that both government securities and corporate bond securities, the acceptability of Indian instruments or Indian fixed income goes higher, because they are, if someone is already having exposure to it, that means most likely they are already tracking the country and they are aware of the broad macro factors in the country, which means that if you are tracking a country and its relevant large corporates, the demand or the accustomedness to Indian fixed income will go with these foreign investors or foreign saving pools. The fourth, and which in my view is one of the most important beyond the forex needs, what it does is that it enables that we get into the larger saving pools beyond the domestic savings. Now, why I'm saying this is that look, India runs BOP deficit, or you can say India runs current account deficit. So India is dependent upon the foreign savings pool because India is a capital starved country. Now, as these flows comes in, the domestic saving which is being invested in these existing govies in the form of SLR by banks, or you can say in the form of extra SLR by insurance, pensions, mutual funds, and variety of domestic saving pool, because there is another buyer which will come and compete with us with a similar supply. What it does is that it releases some bit of pressure on yields, and also it releases some bit of capital pools locally, so that it can look to invest beyond the government borrowing, which means that banks who are running excess SLR, or by statutory or because of the higher yields that the government offers compared to the corporate bonds, these banks will be able to fund that released saving pool to meet the local credit demand, especially the long-term infrastructure demand or the private capex demand, which up till now has been largely been investing into govie bonds. So in a sense, although not materially large, but there is some pool of money which will get released, and it will fund our long-term growth needs, and it will fund the capex needs. So these are the broad advantage. As far as the cost is concerned, of course, because we will be part of these indices, and at times when the emerging market outflow happens, we'll also be part of the overall outflow pie. So you can say that the volatility part of the govie securities and currency markets will go at margin higher. The second thing is that because it will impact both currency and government bond markets, and which are very important for the macro stability locally, it will need a lot of intervention from authorities, both at fiscal front and RBI front, in the sense that policymakers, they need to conduct more prudent economic policies, more prudent and sound fiscal roadmap to make sure that the overall stability, both in growth, inflation, and these flows doesn't get questioned by these FI investors. At the same time, RBI needs to intervene both in rupee markets and in currency or in interest rates markets to make sure that these one-time flows or these chunky flows, they don't exposes the local savers and local capital distributors to very high walls. So these are the variety of the costs that these which are associated with these flows. There are news that after JP Morgan index, probably other indices are also thinking to make part of index. So we are very hopeful of Bloomberg index. We expect this announcement on Bloomberg inclusion also to come before November end, and weightage anywhere between 0.5% to 0.75%. But because the Bloomberg is one of the larger indices, you can expect another closer to $10 billion inflows in a very short span of time if that inclusion also gets approved by Bloomberg indices incrementally. Now there is another set of interested news which has just come a week prior to this announcement, and that was on the regulations that was relaxed by RBI, that how much security can be held in HTM, in the sense that about a week prior to this announcement, RBI released new guidelines on the investment portfolio where RBI allowed banks to buy unlimited amount in HTM portfolios. Why are HTM portfolios important? Because these are the portfolios which if the banks are buying these securities under these portfolios, they need not do mark to market of it, which means that they are more like held to maturity, in the sense that they are carried in bank books at the acquisition yield. Now we think that the announcement came as a precursor to this announcement, because RBI clearly took decision foreseeing that once the index inclusion happens, that may lead to higher walls, which means that we need a layers of line of defense against the potential walls. So the first line of defense is whenever the large outflow happens, banks or inflow happens, banks can use their excess SLR book, or they can use their HTM book to make sure that the walls are contained. Of course, the second layer is at a RBI level through actively intervening in the both OMO buys and OMO sale. But we think that both the announcements need to be looked together rather than in standalone basis. So this announcement is going to equip banks better to counter the large FPI flows, especially on both sides, both that it's inflow and outflows. So in a way, it's a well thought out strategy by policymakers. Now, look, as such, the announcement, as I told you, that's a one-time flows, and being a one-time flow, it will give you a one-time capital gains anywhere between 15 to 20 basis points at least. But because it's not a significant portion of our overall debt profile, we need to remain focused on running more prudent macroeconomic policies, and which is why we need to be careful of both global macros and local macros despite these flows. Now, let me first touch upon the global macros. Now, recently, US Fed, in their FOMC meeting, they kept the policy rate unchanged, which was in line with market expectation. However, their commentary was somewhat expected, and we have seen.
Sorry for a moment before we move to this US and the global macro. On these alone, I mean, you mentioned quite a few benefits and one issue in terms of volatility, potential volatility, and how government will have to, or the monetary policy will have to kind of take into account for macro stability, etc. Because then there will be so many FIIs also will be watching and reacting to our policies than before. And you mentioned that hold to maturity is again another good way, structural way to sort of reduce the bank's portfolio volatility. In terms of impact on yields, because you mentioned that there are it's a one-time inflow of about 23 to 25 billion on account of JP Morgan, and potentially because this Barclays Bloomberg index, if that also happens, another 10 billion or so. But that's a one-time, and then there are structural benefits. What do you think is likely to be the impact on 10-year GSEC, Kaustubh, because of this because of this development alone?
So look, Bhavdeep, our current 10-year yield is closer to 7/4, and taking into account the flows or potential flows which are going to come over next 12 months, our base case is that 10-year yields will move closer to 7. That's a base case. And if the global macro turns out to be conducive, so we are at 7/4 in the backdrop when US yields are near to, you can say, last 15-20 years high. Okay, and when the energy prices, they have gone up back from $65-70 to closer to $90. Now, in this bad backdrop on global front, we are at 7/4. The base case is that if US Fed continues to remain higher for longer, which means that there aren't no deep rate cuts, the base case is that these flows alone can take yields lower closer to 7. we as a fund house, we are of the view that we will see massive slowdown in US in middle of 2024, and that will force Fed to cut rates and ease policy at margin. If that happens, and that coincide with these flows, then I won't be surprised that Indian 10-year can move closer to 675 as a best case scenario.
That's
So you
quite
can say
encouraging.
the best case is more like 7. You can
Mm-hmm.
say, or base case is like 7. The best case is more like 675.
Mm-hmm.
And of course, the worst case is more like closer to 735, 40 over next 12 months, assuming RBI doesn't do any rate cuts.
Sure.
Our base case as a fund house is that RBI doesn't do any rate cut, but if India growth slows down meaningfully, and if RBI do rate cuts in that scenario, once the Fed starts
Even
doing
better.
rate cut, then we can go down even more. But
Perfect. So
uh,
broadly, it looks like, I mean, basis what you summarized, it looks like it's the risk reward is in favor of duration at this point in time because you're
clearly,
saying.
clearly. So
Yeah.
for the first time, I would say post-COVID,
Mm-hmm.
when the rates were brought down to 3/4,
Mm-hmm.
for the first time, we can say that globally interest rate normalization is peaking.
Mm-hmm.
In fact, I would say that our base case is that rate hikes, they are over now, both in India and global world.
Okay.
The timing of rate cuts is still some distance away. Either
Mm-hmm.
it need big slowdown in growth or
Mm-hmm.
massive correction in commodity prices, or you can say some bit of financial accident,
Mm-hmm.
which is difficult to envisage in a normal case. But uh, that the policy normalization force, which was there from last 24 months, is behind us now.
Oh,
For the first time, I would say that inflation seems to be finally responding for the tighter monetary policy at margin, and at margin, because once the growth slowdown is more visible, the pressure will be to ease financial condition rather than getting it more tighter and tighter.
got it.
So,
Interesting.
fixed income, especially duration call, has never been as good in last, I would say, post-COVID.
Mm-hmm.
So, which is why at margin we are constructive on durations, and we do think, although we will have a lot of walls over next 3 months, because we are now in a transition phase from tightening biasness to neutral biasness. But the
Mm-hmm.
path 1 year down the line is lower for yields.
Got it. Interesting. So thanks, Kaustubh, for that view on government, I mean, the yields in India. Now, for our all viewers, just want to share with you that we are looking at launching two funds, which fund of funds essentially, which will be investing into US Treasury bond ETF. Because we believe that the rates are pretty attractive. The what's and whys of that we will listen from Kaustubh. But it is just in the context of that, our view on global macro, particularly, is very, very important and relevant. So yes, Kaustubh, over to you now. You were sharing with us on the global macro side. What's your view, and why is it that someone should look at U.S. Treasury bond yield products from here on for the next 1 to 2 year period?
Yeah, sure, Bhavdev. Now, before I get into it, let me just also conclude at the first part of our conversation, which is on index inclusion, that because we are constructive and we do think the risk reward is in favor of adding duration at these levels in Indian government bond market because of this index inclusion news, um, I would say that if you want to play this trade, ideally you should come through either actively managed gilt or income funds, or we are also planning to launch some of the index fund strategies which can play this index inclusion technical trade. Why it's technical? Because it's like a one-time flow, and that one-time flow technically can lead to some mismatch in demand and supply and can yields lower ceteris paribus. So some of our index strategies also will come back very shortly as a proposition, as a passively managed index inclusion stories. So both actively managed and passively managed funds will be available for our investors to actually exploit potential index inclusion benefits for our investors. So you should look, if you are looking at a local yield market, I think you should look both active and passively managed funds, depending on your risk appetite. And we'll try to make it across the curve, which is starting from 4 year, 5 year, 7 year, 8 year, 10 year, and depending on the scenario analysis, will come out with very, very potent communication onto it, and accordingly you can advise your investors to have exposure in these strategies. Now coming to the global macro, the point is that US, of course, they kept their rate for the first time. They kept their rate unchanged in line with market expectations. Market do assign some bit of probability of another rate hike in US in November. Uh, Although they kept rate unchanged, but their commentary was reasonably hawkish. And post the US FOMC meeting, actually market yields, they are higher by about closer to 50 basis points in last 15-20 days. How the commentary was hawkish is because markets are pricing, or Fed has guided that they will cut rate by 100 basis points in calendar year 2024. Now through their dot plots, they've changed that cut from 100 basis point to 50 basis points. Now our view is that it's true that in 2023 or the start of 2023 as well, most of the economists, they were of the view that US will see kind of a recessionary conditions, and that will see reasonable amount of rate cuts. Thankfully, we were not of that view, and which you can see in our annual letter. We were of the view that rates are likely to remain higher for longer, although we were of the view that somewhere in June Fed will peak in terms of rate hikes, but Fed did hike one more hike beyond our expectations. But actually 2023 turned out to be better because of very active fiscal play that US did. As a matter of fact, as we speak, US fiscal is running at a run rate of 7.5%, which is outside of any pandemic or war. It is one of the highest. So although monetary policy is tight, but fiscal is way too loose, and it is completely outpacing the monetary policy tightness which has happened up till now. Another thing is that because of removal of debt ceiling, the checks and balances in US to fund the fiscal deficit is gone for some time, and which is why up till now, at least US has been able to fund this debt without much of cost. The third reason why 2023 turned out to be better is that because the saving pool, which was carrying as a part of COVID stimulus, it took longer than what market consensus was, and along with a large amount of mortgage which remained locked in at a fixed rate, the variety of the reasons enabled US economy to turn out to be a lot more cleaner and stronger than what the consensus estimate at the start of 2023. Now we are near to the fag end of 2023, and our view is that some of these positives, they are now getting behind us, in the sense that, of course, the debt ceiling is gone, but if you are closely monitoring the politics in US, their speaker got fired because of the avoidance of government shutdown, which means that the avoidance on the overall, you could say, the borrowing requirements that they were having, which means that incrementally the probability of unchecked fiscal spending is now getting at margin, has some bit of checks and balances, which is likely to be placed over next 45-60 days. The saving pool that has been the biggest savior, it is now out of, you can say, it has almost pared down, and now actually saving pools is back to pre-COVID level. The third reason is the lower commodity prices and lower energy prices, which were acting as a stimulus because of energy prices movement in last 2 to 3 months. At margin, US consumer, especially the lower strata in US consumer, is now feeling the heat, and given that their mortgages rates have reached at an unprecedented level, we do think that somewhere in Q1 of 2024 or maybe Q2 of 2024, we'll see very sharp slowdown in US, and which is why we think that as far as rate hike is concerned, US is done with it. Given that real rates are now near to 2.5%, which is in last 30 years we have not seen that kind of real rates. Given that the labor markets is already seeing signs of softness, given that at margin, you can say that the flow data is showing the signs of slowdown in the economy. And given that even like India, US is also have elections next year, and clearly the inflation will remain priority for them rather than growth slowdown. We believe that rates have peaked, and if the pace of slowdown is very large, probably US will cut rates more than what they have guided, which is 50 basis points. And thus, we do think that as far as the duration in US, which is like treasuries are concerned, at a closer to 475 to 485, these are very lucrative levels. And if someone has an investment horizon of 12 months to 18 months, we are very, very confident that there is a large duration, potential duration gains which can accrue to the investors in US Treasury markets. In fact, um, although we invest largely the local fixed income money, but I won't. Um, to be truthful, I would say that as of now, US Treasury market is cheapest asset class in the world, and which is why uh, we are of the view that if someone has a reasonable investment horizon of 12 months to 15 months and have a ability to some way have exposure to US treasuries, that's the first and cheapest asset class that investors should look forward to, and which is why we are coming with fund of fund in US treasuries. Now, we will give options to investors to invest in 3 year, 5 year, and 10 year, which means they can pick and choose. Um, and most likely, at the end of maybe 12 to 15 months, I think in terms of asset class, that's going to be much more rewarding. As an operational efficiency, we have negotiated very, very competitive rates with these index providers for our investors. So we are coming with a very low expense for them. The transaction cost is going to be one of the cheapest in the country, especially if you are investing through mutual fund route. And just to give you the extent of sell-off, then the pace of sell-off in US Treasuries is even outpacing the pace of sell-off that US saw in equities in 2008 in terms of magnitude of loss that US Treasuries have seen in, or US 30 years have seen in last, you can say 15 months. So I think it's a great opportunity, although it's little tactical, although it is going to be a lot more volatile than local fixed income markets. So Indian fixed income markets are too serene in the sense they are their volatility part in Indian fixed income market is absolutely negligible. Unlike India, US markets are too volatile. And just imagine that India rate is 7% or 7 plus minus something, and daily movement is just 2 to 3 basis point. In US, the big figure is closer to is in 4 or closer to 5, and daily you can see 15 to 20 ticks basis point movements. So that's the kind of volatile animal that is, and which is why you need to kill that volatility by having a reasonably longer period of investment horizon. But in our sense, this is one of the best time to invest in US treasuries, given the rates have peaked, given that the economy is entering into slowdown, given that their fiscal will contract at margin, and given that the real rates in US is near to you can say near to 30-year high, which is at closer to 2.5%. We do think these are the great investment opportunities for our investors, and in my view, these are legitimate. And given that US is one of the most liquid markets in the world, uh, I think these are legitimate opportunities. The total pie which we can fund in this is not too large, just 300, closer to 300 to 400 million dollars, which means that it will be on first in first out basis. That and in my view, investors should seriously look as a asset class, much better asset class, much more liquid asset class in their investment bouquet. So that's a great opportunity. We are going to launch this in Navratri. The fund will close before Diwali. The fund will remain open for closer to 15 calendar days. So my urge to you is that if you also think that US rates have peaked, or you think that in US the policymakers are now probably near to what they wanted to achieve in terms of breaking inflation momentum from near to the double digit number, now closer to 2.5 to 3, I think that this is the right time to invest in US treasuries.
Interesting, Kenny. So I think very sharp outlook and opportunity, mentioning that US Treasury is the cheapest asset class in the world is quite a statement. And as you rightly mentioned, I think the product structure that we are offering is quite efficient. And in terms of liquidity, US Treasury, we all know, is the most liquid asset market in the world. So I think combined all these factors, looks like it's a great opportunity. And you can pick the tenure or the yield 3-year bucket or a 5-year bucket or 10-year bucket for what kind of is suitable to your investment needs. But this is something which is very interesting investment opportunity for you to look at. And as we launch it sometime next week, we'll get in touch with you. You also be in touch with our sales team, and we'll be very happy to assist you in your product investment process. Thirdly, Kaustubh, tomorrow is the monetary policy. So I think a little bit of insight in terms of what's in store, what's our view on that, whether the rate hikes. I mean, the rate cut, whether in 2023, I mean, hikes. I think you have already conveyed that view. But what does it mean in terms of short-term and long-term yields? And what are the product propositions that you think, given your view, that one should ideally look at?
So, Babji, the point is that look, unlike globally where the economies are clearly showing signs of slowdown, in India, for FY24 we expect growth to be closer to 6 quarter, and if at FY25 also we expect growth to be closer to 6%. In the sense that there are two big risks that the country is running for next 6-8 months. One is local, which is political cycle that we are in, and everyone wants stability in terms of policy making. So the ask for the markets, or the markets are prepared for that, BJP will come with full clear majority. So that's the one risk. And the second risk for the country asset class is coming from what's happening on the energy prices, because there are reasonable amount of walls on the both sides. So and our base case is that BJP will come with absolute majority and energy prices will remain sub 100 for calendar year 2023 and maybe calendar year 2024. Now, if that base case turns out to be true, we expect India to grow at closer to 6% in FY 24-25, irrespective of global slowdown that is impending on us. Now, at a growth rate closer to 6, it's difficult to envisage that India inflation will be lesser than 5%, and which is why, as a house, we are of the view that India, there are no rate cuts in India in 2023, in 2024, or probably even in calendar year 2025, or at least the first half of calendar year 2025. So we are higher for longer. RBI will keep rates at closer to 6.5 for good next 15-18 months minimum, and maybe for closer to 2 years from now, rates will remain here. So we don't see a space for rate easing for RBI, but at the same time, they will keep liquidity to be neutral till the time the global uncertainties are not out of the way, and which is why in tomorrow monetary policy we do think that RBI will keep rate at pause. They may not announce any incremental liquidity measures now, but sometime in next year, once these index induced flows starts juicing up, there will be some measures to infuse that kind of liquidity, that maybe in the form of CRR hike, maybe in form of almost sales, maybe in form of some market stabilization bonds, but that's still 6 months down the line, or maybe at least 3 to 4 months down the line. But at least from here till March, we don't expect any liquidity measures or any potent liquidity measures which can be disruptive for markets. So our policy rates are in positive real rate territory. Our rates are reasonable to where they were pre-COVID levels. Our inflation is not misbehaved as most of the developed market economies have misbehaved. And unless you see energy prices crossing $100, I think we are in here for longer, in the sense we will remain in the status quo, and at margin RBI will do little bit of tweaking on liquidity, but nothing beyond that. Now this gives a perspective that probably large duration gains are not there on the table, and which is why we were I'll say conservative in our duration call all this while, and which has helped us to kept in a good state of in terms of fund performance. Okay, so the only delta or only move that we have made is that because this index inclusion news, we do think that probably the government securities markets or the govies, especially the FAR securities where these FI or FPIs will be able to invest, those securities can settle little lower, anywhere between 15 to 20 basis point at minimum, and probably potential 50 basis point if that is being coinciding with the global slowdown. But so we remain, I would say, cautiously constructive now, in the sense that we don't want to run very high duration risk. But whatever duration we are increasing or we have increased, we have done it purely through Gavi securities, which means that we are not constructive on spreads. We do think the spreads will expand. Now there are two ways a spread can expand. One way is that the absolute level of the corporate bonds goes up and GSEC remains where. Other ways that GSEC comes down and corporate bond stays wherever it is. Now, so we do think that the next 6-8 months GSEC will go down, but corporate bonds will stay wherever it is, because the banks are now stretching out in their incremental credit deposit ratios. And probably once the election cycle is behind us, there will be new credit cycle will pick up, and that will make sure that the spreads remain elevated. So both the things are making us believe that one should be underweight corporate bonds, one should be overweight GSEC. Within GSEC, one should be overweight only for securities, which is those securities which are eligible for these index inclusion guys, FPI guys, and beyond these, we want to remain focused on accrual largely through 1 year and 2 year funds, which means that overall duration is not going to increase big way. But whatever duration we want to run, or whatever the tactical portfolios we want to run, we will run it only through Gavi bonds, and which is where how actively managed funds will be managed, and which is where I'm trying to make a little bit of distinction that if someone wants to do a pure play of FAR securities, then probably index strategies, which we are going to come out in next 7 days to 15 days, that make a lot more sense. If you are comfortable with our sense on actively managing funds, then our actively managed funds will be overweight these securities. We will be underweight corporate bonds, but we'll continue to remain closer to 1 to 2 year durations across all our funds, except you can say gilt and income. So it's a little bit of nuance fixed income play. It's a little bit of nuance, I would say, tactical duration play that is going to play out over next 12 months.
Okay. Thanks, Kaustubh. So, Mr. Rahul is asking your view on Indian long-term, long-duration products, GSEC or long-duration fund at this juncture. And let me just add my bit too also in terms of another question, related question is, what would you suggest in 1 to 3 year segment also? When our dynamic bond fund currently, I think, well over 4 years in terms of duration, I think 4.3 or so. So what would you suggest to say a very aggressive investor with a 3-year horizon? Or a relatively conservative to moderate investors with say a 1 to 2 year horizon on the fixed income side.
So
for local, for India bond products, India duration products rather than the overseas. Overseas, anyways, I think you're very clear in terms of what do you expect.
Yeah, so for conservative guys, I'll prefer corporate bond funds and banking PSU funds. They will manage duration between 2 to 3 year. But I will say more than 50% of the duration is coming through these govies, which are FAR securities. If you exclude that, then the average maturity of corporate bond or residual portfolio is less than 1.5 year. So for conservative guys, for aggressive guys, which means that they need to have an investment horizon of 3 year or more. Of course, dynamic bond funds or maybe income and gilt, they make a lot more sense on actively side of it. If you want a passively managed funds, then some of the index opportunities can also be looked through it. These index opportunities will be investing only in FAR securities, tactical plays. Currently, they are at 7 quarter. If you assume that Gavi yields move closer to 7, then one can expect over next 1 year, purely on a scenario basis, if actually yields move the way we envisage, we expect investors can expect returns anywhere between 8 to 8.5 from a range perspective, ceteris paribus. But that's a passive managed strategy. But actively managed funds, of course, dynamic make a lot more sense if you have a 3 year investment horizon now.
Yeah. Thanks, Kaustubh. So before we take one more question on the US Treasury side, very interesting question has come, and 2-3 people have asked the same question. But before that, I also wanted to kind of take your view. I know you manage fixed income, but What do you think will be the impact of this JP Morgan bond index inclusion in on banking and financial services sector on the equity side? Do you think would you like to hazard your view on the potential impact there because the treasury side or because the asset or liabilities side of their business? Any impact?
So, look, there are some potential capital gains which will accrue in the sense that guys who run longer duration and guys who run excess SLR, which is specifically PSU banks, they will have potential capital gains in their AFS and HTM portfolios. So, but it's like a one-time gains, and I don't think, whatever limited understanding I have equity, that uh, these are game changer gains, and that's relatively that is going to give massive outperformance. What banks and financial institutions or financial services exposure is going to do well is that if India is going to grow at 6%, which is what my base case is, assuming that BJP comes with full majority and crude stays below $100, India can grow at more than 6% or closer to 6% consistently in the world where growth will be anemic for next 12 to 15 months. And the credit cycle in India beyond retail is absolutely absent in last 10 years. Capacity utilizations have gone up. You can say banks, they will be able to free up some of their SLRs holdings to fund this capex. The corporate balance sheets are a lot more cleaner today, and there is intention by government to push capex both at a public platform and a private platform. Once the political uncertainty is behind us, we do believe that India is a cusp of new credit cycle on the corporate side as well. So retail cycle is anyways doing very well, and retail is the only piece which is doing well in last 10 years. Okay, it did saw a blip into COVID, but barring that blip of 2000, or prior to, you can say, credit crisis of 2018, but barring that 2.5 year, generally retail cycle has done very well in last 10 years. But corporate cycle has actually struggled all this while. Now, the NIMs are potentially significantly more if there is a corporate credit instead of retail credit, because the demand is on a larger chunk, and generally banks have, I would say, better bargaining power when they lend to the corporate guys instead of retail guys, because the associated risk which comes along with the corporate book. So I do think that if India checks on the two risks that I cited about, and India grow at 6%, given that the ecosystem which has been developed both on digital side and financial economy side, I do think that the banking and financial services is going to do reasonably well for next 3-5 years, and all across, whether it's PSU bank, private banks, NBFCs, everyone will be a beneficiary because the pie is growing at a significantly faster pace, and everyone has cleaned up the books, which means that when this kind of credit cycle happens, the only risk is if there is any large one-time credit cost which comes all of a sudden. Now that doesn't look the criteria for now, because India household is underlevered. They are not in a deep stress, or they are not in a stress as such. The corporate are cleaner. Banking balance sheets are cleaner. Banking balance sheets will have some bit of treasury gains, one-time treasury gains because of this index inclusions. So all tick box is in place for the ability part of it for the new credit cycle. As far as the willingness part of it, I think the last straw which is left is political uncertainty, which is going to get clearer in next 3-6 months. So personally, I am relatively constructive on banking and financial services per se.
Got it, Kaustubh. Thank you. So, a couple of questions on the 3-year, 5-year, and 10-year security. So, two questions. One, Nandita Singh is asking: will the exposure in US Treasuries FOF 3-year, 5-year, 10-year be target maturity kind, or it will be maintained as same average maturity? So, essentially, constant
So it will
maturity
be
or
constant.
maturity?
So it will be constant
So, constant
maturity.
maturity.
It will be
Right.
constant maturity. Look, although we are investing in constant maturity fund, but on your behalf, we are going to actively give you call if we have to exit at some point of time. In the sense that if we do think that look, rates are elevated, and rates have ability, or they are likely to cool off over next 12 months by at least 50 to 70 basis points. So when we are guiding you for these kind of duration, because it's a lot more volatile market, if at any point of time we do think that the rates have rallied a lot and you should move from instead of 10-year to 5-year, instead of 5-year to 3-year, 3-year to 2-year, or 2-year to maybe 6 months, we are going to give you that kind of substitute to move upon. Good thing is that the baggage of Indian fixed income that you have to come for 3-year to take tax advantage is no more, right? So like all of us want that 3-year tax advantage should be there, because that make it more efficient. But at the same time, not having advantage also give you tactical opportunity to switch once the tactical opportunities plays out. Now this we do think is the next 12 to 18 months tactical opportunities. So we'll come out and we'll guide you in best of our knowledge. If at any point of time we do think that the trade has played out or the tactical trade has played out, and we'll guide you wherever the best next you can hide on.
Okay. Thank you, Kaustubh. So, two questions again related to this. Lot more questions I'm seeing on US product side. One is what would be the so Anand Katrapati, he is asking what would be the expected returns if you hold for 3 years period in US bond FOF, which is going to be launched. So that's one question. Another question, one is anonymous. Someone is asking what is the with respect to US debt out. Just one. Sorry. Another question is. What is the rates remain higher for longer in US? Also US Treasury 1, 3 or 5. What is your preferred choice? So one is what is your preferred choice 1, 3 and 5, and second is what could be the expected return if one holds these investments for 3 years 3 years horizon.
Look, the first point is what is a preferred choice at this point, because we are constructive on duration. I would say 10-year is the best point. Because that's going to react much more compared to 2-year and 3-year.
Okay.
Also, our view is that of course US is going to cut rates, but it's not like a previous cycle of 2008 or maybe 18 or maybe COVID, when the rate cuts are going to happen by 200-300 basis points. Rates will still remain higher than what they were pre-COVID levels. Which is why probably it's like curve will settle lower most likely, but the belly of the curve is going to get maximum advantage compared to the shorter end of the curve. The second question, which is on expected return, so you will very shortly get a deck on these funds, and we'll also try to make some bit of scenario analysis, and that will be through that scenario analysis, I think you will be able to make out that how the returns are going to stack up if those scenario analysis play out. Again, it's let me, for a regulatory purpose and also from a money manager perspective, these are not guaranteed returns, but look, the objective as a money manager is that we the only job I would say is I can justify is that we try to make various probabilistic scenarios, and that probabilistic scenarios are able to give you some bit of payoffs. So we'll try to share those payoffs with you. If those scenarios pans out in the manner that we envisage, of course the payoffs that will come you should be able to extract. So look for that note in next 1 week. We'll get those notes, and in my view, look, 3-year in these times when things are too volatile, both on geopolitics, or you can say commodity cycles, or you can say in terms of monetary policy acting, what we envisage or what we want our investors to look at for like a next 1 year and 2 year opportunity, we'll come out with a regular communication on our view onto it. You also not only invest or look to these notes at the time of investment, but also push my sales guys or push our sales guys to keep updating you with the regular notes that we'll be sharing with our sales team, so that you'll get to know what's the incremental view is. And at some point of time, if you're closely following those notes, I think you'll have a better clarity whether you want to or you should stay for 3 years or maybe 12 months to 18 months.
Sure, Kaustubh. Now we have last 5 minutes, and let me just bunch up a couple of questions. We have a few more. We'll not be able to do justice with all the questions at this point in time, though. So one is Mr. Amit is asking, why are you going for fund of fund? Why not ETF for the overseas treasury products? So that's one. And second question from Pramod, Mr. Pramod is Vedanta Group, the view on that. We also have some exposure to it. And what's your view, because it's in the news in terms of its funding, etc. So yeah,
Yes.
if you can just answer this too.
So on the first question, why we are going to fund a fund? Because we did our, I would say, our analysis on both part. From an operational perspective and from an efficiency perspective, we found fund of fund is a lot more competitive for our investors, and which is why I'm telling that when we come out with a note, you'll have all the details in terms of how low these expenses are, both at our level or maybe at a fund of fund level. So you won't complain on that part of it. And which is why after doing this analytical part of it, we were of the view that fund of fund is a better route, even expense adjusted, for investor to invest in these funds. The second part, which is on the Vedanta, look, yeah, it's true that the Vedanta resources is going under the bad patch, and they are getting into probably some bit of a restructuring exercise. My exposure is not on Vedanta Resources, which is their holding company offshore, but it is to the local entity. Now, local entity is not in that kind of a problem. Our exposure is residual maturity now less than 6 months. It's not a significant part of our portfolio. It's a floating rate loan, which means that we are getting reasonable yield onto it. And most important, we do think that the local balance sheet is not going to face significant amount of problem in this restructuring exercise. Also, we are very much confident that even at a holdco level, which is Vedanta Resources levels, they will be able to sail through the exercise or the funding gap that they are having. So A, the problem is manageable. B, the problem, what the company is trying to convey to the investors and lenders, it seems that that's a credible plan that they have to get out of these problems. And C, my exposure is now residual maturity 6 months. Do we intend to roll it over? I can't commit now, but of course, when the maturity comes, we'll reevaluate it. If we think that the problems are not over, or we think that what they are promising to lenders or investors is not able to deliver, probably we will not roll over. But for now, we are not, I would say we are closely watching it, but we are not worried our exposure.
Thank you, Kaustubh. So just to kind of summarize, big view that Kaustubh shared with us today is that post-COVID, the first time rates and the investment opportunity and duration looks as attractive. For the last 3 years, we have never had better times than these in terms of risk-reward ratio for duration products, both for India and more interestingly, even for US Treasury yields. And that's a broad view I kind of could sort of summarize. He mentioned that with JP Morgan, with essentially bond inclusion, our currently prevailing 7-quarter kind of 10-year GSEC could base case be going to 7%, and potentially if US, for example, also sees little bit of pressure on growth and sees some bit of kind of dovish policy, we might see 675 kind of yield levels as well in terms of 10-year India GSEC. Also, you mentioned that in terms of the spread widening, we expect spreads to widen, not that corporate bond rates will go up, but likely that GSEC rates will go down, and therefore credit spreads might widen. But that doesn't mean that the corporate bond holders will have any loss. It looks a pretty interesting scenario to be in right now in terms of fixed income. In terms of US Treasuries, you all know that, I mean, he quite eloquently covered the global macro and why, I mean, it's very interesting because they say 2.5% kind of real rates in US we have not seen for the last 3 decades or so. And that makes it a very interesting investment opportunity to invest in US 10-year. We are coming out with 3 fund of funds which will have underlying as US Treasury, 3-year, 5-year, and 10-year. And Kaustubh believes that, and we believe that as a fund house, that 10-year US Treasury version or that particular product will be most interesting because we are very constructive on treasury yields in US as well. So that's broadly the view that we have had. I hope it was useful for all of you. Look forward to your support and you all joining our Your Market Navigator series. It's a weekly conversation, and our endeavor is to make sure that we share with you through our fund managers and with our fund managers our market view as well as product specific views with all of you on a regular basis. So thank you very much once again for joining us on this call, and have a wonderful day ahead. Thank you. Thank you, Kaustubh, for sharing your views.
Thank you, Badil, and thank you everyone for joining the call. Thank you.